Afternoon, everyone. Welcome to the third installment of the Healthcare Realty Group webinar. We're so grateful to have you all here with us today, and we really do appreciate the support. If this is your first time tuning into the webinar, welcome. My name's Chaz Feitel, and if you want to know more about HPRG's story and see a list of our services, please visit our new website, which Sarah actually helped spearhead, and it looks great. It's fantastic. It's at www.hprgrealty.com. And learn more about how we can make your practice more money through real estate. So today on the third episode, we're joined by my co-host and my big sister, Sarah Feitel. Sarah, how you doing?
Hi, everyone. Good.
All right. And also, we're going to talk about the CARES Act and the Payment Protection Program. And obviously, you've heard a lot about that already. So this time, we're going to be focusing a little more on what we don't know. And in order to do that, we're teaming up with Patrick Dennison of Fisher Phillips, leading labor and employment attorneys. Patrick, how are you?
I'm doing well. How are you? Thanks for having me.
Yeah, thanks for joining us. Thank you so much. Patrick hails from the great state of Pennsylvania, as we were just talking about. And he's a member of the Fisher Phillips SBA loans team, and he's dedicated to advising employers on the inner workings of the complex CARES Act and loan process during the COVID-19 coronavirus pandemic. So Patrick, again, thanks for joining us. We're going to jump right into the material since we've got some limited time here. It's May 13th. Most of our clients have already applied, been approved, and received or even started spending their money. So I guess the question is, what's next? What now?
Well, at this point, everybody should be thinking about the forgiveness portion of the loan and how they're expected to, one, calculate that amount so they can stay within the parameters of what the CARES Act has provided for the PPP loan program, and also, staying within the 75-25 rule that actually isn't in the CARES Act, but the Treasury and SBA decided was important to promote people spending or businesses spending the money on payroll costs. So we have at Fisher Phillips, we put together a team of attorneys to really delve into the CARES Act whenever it first was introduced by the Senate on March 25th. So I was one of those attorneys, and we had gone through the process. The beginning was using the guidance that Treasury had put out and developing what borrowers would need to get the loan. So now where we are is we're focusing really on the loan forgiveness aspects. And so we've put together what we call the 10 steps to paycheck protection loan forgiveness. So really step one is separating the categories of payroll and non-payroll costs. So I'm sure most of this is going to be a review, but payroll costs are defined in the Act. And it includes compensation up to $100,000. It includes group health benefits, paid sick leave, medical, family leave, insurance premiums. Included in the compensation, you have to remember, are salaries, commissions, and other similar compensation. It also includes, though, state and local taxes. It does not include federal taxes that you would have otherwise paid on employee compensation. Non-payroll costs are mortgage interest, and that mortgage would have to have been in effect before February 15th of 2020. It also includes, though, interesting and important to you all, rent payments and leases. And so those can be included in what is forgiven, but we'll talk about the 75-25 rule that I had included earlier. So once you've done that and you've separated your expenses into those two categories, you're going to have to look at the amount of payroll costs versus the amount of non-payroll costs. And so in step 2, you should calculate the total amount of your loan and then determine whether you can get the total amount into the 2 figures of the 75-25 spent during the 8-week period after the disbursement of your loan. So again, let me go back. It's important to remember that your 8-week period for the loan forgiveness starts the first day that the loan was dispersed, okay? So once you've added up those costs, you can then look and see if you can put your payroll costs into the 75% category and your non-payroll costs into the 25% category. Again, the 25% category will be things like rent, leases, utility costs, things like that. So once you get to that point, you move on to step 4, okay? And you're going to multiply the total PPP spend by the 25% to get to the limit of your total potential forgivable non-payroll related costs. It's important to remember that, you know, when you initially took the loan or you put together the documents to get the loan, the amount, the calculation that was used to get to the amount that you otherwise needed was 2.5 your monthly payroll expenses, okay? And so really what that averages out to is 2 months of payroll, and then the 0.5 was for everything else. And so just because you got that maximum loan amount doesn't necessarily mean that you're going to use that entire amount over the course of the 8-week period.
Right.
So we've had that question come up over and over again. And, you know, well, I can't spend, I've done the calculations you suggested, and I can't spend that amount of money on, you know, 75% on payroll costs within the 8 weeks. Well, then you have to maybe scale it down a little bit, and you're going to have some money left over. But, you know, again, remember, this is for determining loan forgiveness, which is pretty significant. So once you've done that and you've determined the amount of the non-payroll costs, you then have to move on to the calculations that that you're going to need to determine whether or not there's going to be any loan forgiveness reductions, okay? And so there are 2 calculations. The first one deals with full-time employee headcount. And full-time employee headcount, we don't have the guidance yet from the SBA or the Treasury on what is considered a full-time equivalent employee. But with that said, the SBA in the past has taken the view that a full-time equivalent employee is an employee who works at least 30 hours a week. Okay, so to give an example, a full-time equivalent employee would be 2 employees that work 15 hours a week apiece. Okay, so that would equal 1 full-time equivalent employee. But we're still waiting on guidance from the SBA about that issue. There are some documents on the SBA's website that date back to around 2014, which give you some idea of how to calculate the full-time equivalent employee headcount. So what you're going to do is, over the 8-week period, you're going to have to get an average of your full-time equivalent employees. And then at the end of that 8-week period, you're going to compare it to one of 2 averages, 1 of 2 dates. The first date is February 15th of 2019 through June 30th of 2019. So your full-time employee headcount during that time, or January 1st of 2020 through February 29th of 2020. The borrower gets to choose one of those 2 comparison dates. And so let's just use an example. If you had 25 full-time equivalent employees over your 8-week period, and you had 30 over your look-back period, you would take the 25 full-time equivalent employees over your 8-week period, divide that by 30, and that's going to give you a quotient. And in this case, it's 0.833 repeating. You will then take that quotient and multiply it by the amount of money you spent over the 8-week period. So that would be your loan forgiveness amount. Okay. And whatever reduction, again, it's going to be about 83%. So whatever reduction in employee headcount you had over the 8 weeks factors into the reduction in the amount of loan forgiveness.
Okay.
The next calculation you're going to have to consider is the reduction in employee compensation by more than 25%. And the look back period for that is the most recent full quarter in which the employee was employed. And I think for most, if not all borrowers at this point, that would be January 1st through March 31st. So you're going to look essentially to see if there were any reductions greater than 25% for individual employees. And if there were reductions in excess of 25%, then you take the excess of the 25%. So off of your total loan amount. So just to give an example, and this likely wouldn't be true over the 8-week period, but you can imagine it annualized. So you take, if you had somebody that was making $40,000 a year and you reduced their salary to $20,000, then that would be a 50% reduction. The total reduction would be $20,000. The excess of the 25% then would be $10,000 of that. So that would be annualized though over the 8-week period. So for each employee, you're going to look at that, and to the extent there are reductions beyond 25%, you're going to then further reduce that from the amount of your loan forgiveness. Once you have that, we don't have particular guidance from Treasury or the SBA, but my understanding is around the 7th week of your covered period, you're gonna have a bank reach out to you, your lender's gonna reach out to you, and you're gonna have to provide documentation what your prospective loan forgiveness amount's going to be. Okay. And so once that happens, at this point, we have a little bit of an idea of what's going on, but the SBA and the Treasury just has not given us the clear guidance that we need at this point in time.
So, and I believe that leads us into our next question, which was, you know, this administration and Congress were under intense pressure to provide us with some kind of relief program. So inevitably there are going to be some major pitfalls with the PPP. Do you talk about those and some of the ramifications we could be facing if we fail to meet some of these certifications?
Sure. If you sit down at your computer and you Google PPP loan, and you then hit the news stories yesterday and the day before, and I'm sure you'll see some today, there were multiple stories written in the Wall Street Journal and Forbes talking about, one of them I think called it a bait and switch. And so initially what this program was touted to be was, you know, we're going to give small businesses an opportunity to keep people on their payroll. And as you know, a lot of businesses were shut down, not because they chose to shut down, but because they were forced to by the states. And so, you know, initially a lot of people thought, well, can I just use this money to pay my people even if they don't have any work? You know, and we went back and forth as a group with that. And it appeared that they were just, that Congress and the federal government, they were trying to give small businesses an opportunity to, you know, for lack of a better term, weather the storm over the next couple months. Because again, think about it from this perspective. This is a short-term loan period, right? They want you to use the most amount of money you can on payroll over a 2-month period. And if you can do that and you can stay within those parameters, then theoretically it would be forgiven. And there were some, the SBA has rules that apply if you ever try to get a loan from them. A lot of the red tape was taken out of that. One of those being a requirement to have credit elsewhere. That was completely removed from this program. So a lot of businesses looked at that as, hey, you know what, we're really struggling. We haven't sold, we haven't sold a car, or we haven't had a patient. We don't know what the future is going to look like. And then so there were these certifications that went along with it. One of those was a certification referring to the economic uncertainty and requiring this loan to continue your operations of your business. We're in the most uncertain economic times really in a lot of people's lifetimes. So people looked at that as saying, you know what, the government's really stepping up to the plate and trying to help businesses. And then after the loans started coming through and the money dried up, people started looking at the businesses that received those loans. And a lot of those businesses were large publicly traded companies. The Los Angeles Lakers received a loan, and the Treasury and the SBA took a little bit of a turn, and rather than saying, well, these businesses like Ruth Chris Steakhouse, they're shut down, and nobody's buying a filet mignon as takeout, right? I mean, for a special occasion maybe, but businesses that don't have a takeout business, restaurants were not doing well. And so the Treasury ended up coming out and saying, look, we're gonna, I think some people got it wrong, and they weren't actually eligible for the loan. And even though you certified that you had the need for it, if you had substantial liquidity or the ability to access liquidity, then you didn't really need this loan. So they came out with a safe harbor provision, which provided that if you return the loan by May 7th, they would have deemed your certification to have been made in good faith, meaning they won't come after and do an audit. They're not going to investigate you. You pay the money back. We understand there may have been a misconception. May 7th rolled around, and they extended it for another week. So tomorrow is actually the date that we have where they've provided for the safe harbor of returning the funds. In the meantime, the Treasury Secretary has gone out on several news outlets. He's given interviews specifically talking about loans that are above $2 million. So $2 million and more, he said, there are going to be severe consequences for those borrowers who didn't need the loan but took it anyway. And he also talked about the severe consequences that those borrowers would face. And if anybody who has looked at some of the statutes that were provided likely in your loan application and then in the note, there's a lot of talk about fraud and what that can carry. There are also penalties and jail time. One of those, if you've defrauded a federal, an FDIC-run institution, the maximum is 30 years in prison, or I believe $250,000 in fines. So the consequences are very severe, and that has left a lot of businesses going, well, I mean, we have maybe access to some cash, or we have an open line of credit. Does that mean liquidity? The SBA has not come out and said, no, that's what we were talking about. or how much you actually need. But today, about 2 hours ago, let's say, they did come out with a new FAQ. And again, they've been putting a lot of the guidance out by what they're calling frequently asked questions. These are not regulations. These were not in the statute. The new FAQ, number 46, so they're also putting these out one at a time. They're not coming out with comprehensive FAQs that are addressing a lot of people's questions. But the newest FAQ, number 46, talks about, the question is, how will the SBA review borrowers' required good faith certifications concerning the necessity of their loan request? Previously, the SBA said anybody that has a $2 million or more loan is going to receive a full audit from the Treasury, the SBA. They've I'm sure have some task forces put together. So anybody that has a $2 million or more loan was going to get a full audit. They have come out today and said that any borrower, together with its affiliates, that received a loan with an original principal amount of less than $2 million will have been deemed to have made the required certification concerning the necessity of the loan request in good faith. So it appears that they're backing off a little bit from those borrowers who have less than a $2 million loan. That said, even though the certification for the economic uncertainty, which is what they've really been focusing on here in the last couple weeks, there are still other certifications that you had to make, including that the loan money will be used to retain workers and maintain your payroll. So again, staying within that 75-25 limit. For the loan forgiveness amount, if you don't spend all of your money, the loan forgiveness amount, you're going to want to stay within the 75-25, but also if you have money left over, we don't know how that's going to play out, whether or not for the entirety of the loan, you have to stay within that 75-25. So if you got a loan for $1 million and you only spent half of it, and that's what's forgiven, but you decided we're going to take the other half and convert that into a loan that's paid over 2 years at 1% interest, do you have to stay within that 75-25 parameters? Right now, I'm going to say yes. And so again, that limits what you can use the loan for, assuming that you don't have it all forgiven. So it's really, at this point, a lot of borrowers are nervous about using this money because the SBA and the Treasury they haven't put out the guidance that we all need. And so, I think at this point, if borrowers have any questions about whether or not they should be spending the money, they need to take into account and consult an attorney because audits can get very expensive, and the consequences are pretty severe.
Patrick, as part of those new FAQ guidelines that they put out a couple hours ago, they did not extend that safe harbor provision timeline. It's still tomorrow, right?
The safe harbor timeline is still tomorrow. Yes. So there's no requirement if you give the money back. There's no requirement to explain necessarily why you're giving the money back. Okay?
Why?
So that's important. Because if your bank's requiring you to provide some justification, my understanding is right now there is no requirement to do that.
And so we want to definitely get into some of the questions that we've seen compiled here, but just to round up here, should we even spend the money? Let's say we've gotten the loan and tomorrow is our deadline to get back. Should we spend it?
I think for borrowers who can fit within the parameters, if you're really strapped for cash, If you haven't been open for a while, you're losing your customer base, you can do projections and you can see that downward trend in your projections. I think that you can spend the money, and you're going to have to document and make sure you're really staying conservative within those parameters. For instance, we get a lot of questions about bonuses. Can I pay a bonus to this person or this person? Really, we don't know how they're going to scrutinize that come loan forgiveness time. So, if a bonus was contractually based and you're under an obligation contractually to pay that bonus, that's different than just taking this loan money and giving everybody a bonus because you have this loan money. Okay, so again, the SBA just hasn't put out, the Treasury just hasn't put out the guidance regarding the loan forgiveness portion of it, except for you can give the money back and we're not going to scrutinize you. Okay. But if you yeah, I mean, who wouldn't? But if you do have questions about spending this money and you're concerned that you're not going to be able to meet the parameters, or you have to come up with creative ways, then there might be alternatives. You have to look at the risk versus the reward. And again, we're talking about a small point in time. And I recognize that's a very difficult decision for a lot of borrowers, and I'm sure a lot of your clients, because they're put into a really tough spot. And nobody knows, even as we start to open up in Pennsylvania, I think 2 days we're going into yellow, and that's all my kids keep saying to me is, Dad, we're going to be in yellow. Okay, we're going to be in yellow. What does that mean? They think there's going to be some transformation.
Right.
But at this point, a lot of borrowers and businesses just don't know. And, one of the things I do, and I spend most of my time doing, is talking through all of these issues with borrowers and people that have questions about, well, I don't have my so-and-so won't come back to work. They're making more money on unemployment compensation than they would be coming back to work. How does that affect my loan forgiveness? Can I hire somebody else in their place?
Absolutely.
A lot of complex questions are being brought that intertwine with the PPP program and the FFCRA, with the paid sick leave and family medical leave. So, borrowers still have to make business decisions, and tough business decisions, especially at a very difficult time. And in some ways, the PPP program limits your ability to make those decisions because of the calculations for the loan forgiveness. So again, back to your question, should we spend the money? That's a fact-specific, case. It's got to be a case-by-case basis.
Yeah, and when it comes down to it, ultimately, if you decide to do it, whether you're borrowing more than $2 million or under $2 million, document everything. Dot every
documentation.
Dot every I, cross every T. Make sure you're documenting every single dime you spend that they give you. So if they do come back and audit for whatever reason, you can show them that it's gone. It was justified.
Sure. And that leads us actually into a question. Speaking of employees, because I know the whole furlough discussion, and you had touched on it a little bit. A lot of our clients are saying that they're having that issue with their employees. They don't really know how to combat that because many of them are making more money. We have a question here that is talking specifically about the employee, and maybe you might be able to shed some light on this. They're asking if they can substitute a previous full-time employee with a new full-time person in the business that was not previously an employee prior to the COVID situation. Is there any, I know we have limited guidelines from the powers that be, but is there anything you might be able to give us, any information about that may be out there that you could share?
so one of the things, when you're looking at the full-time employee headcount calculation, one of the things you have to consider is the language in the CARES Act just talks about full-time equivalent employees. And so again, to use my example of 2 15-hour employees make 1 full-time equivalent employee. Presumably, if you had a situation where rather than having so many part-timers working, that you increase the number of full-time employees, that would be okay. And that would sort of help meet the metric. But, you know, again, from a conservative standpoint, and at this point in time, until we have some real clear guidance, it's best to try to maintain the status quo, okay? And so naturally, if you have an issue with an employee who doesn't want to come back and you have to make a business decision, be prepared to justify that business decision. One of the things, though, there was a very helpful FAQ that came out, I think, last week, and it's number 40. So if you go to the SBA's website, you can find this. Fisher Phillips, we also have a lot of resources on our website that you can go to and find write-ups on you know, the important FAQs that come out. But the question goes straight to this point, and it says, well, borrower's PPP loan forgiveness amount be reduced if the borrower laid off an employee, offered to rehire the same employee, but the employee declined the offer. And the answer to that is no. An exercise of the administrator and the secretary's authority to prescribe regulations granting de minimis exemptions from the Act's limits on forgiveness, you basically won't be penalized if you made a good faith offer to the employee rejected that offer, and you have documented the employee's rejection. My suggestion would be in writing. So you basically make a written offer to say, hey, you know, we're bringing you back, even if it's a furlough, right? So this is specific to an employee laid off, but if you're reinstating somebody who's been on furlough, you want to provide them with information and have that documented that you have done that. And it says, essentially, it also mentions that the employees and the employer should be aware that the employees who reject offers of reemployment may forfeit eligibility for continued unemployment compensation. And so that's something that you can point to the extent you have an employee who's saying, boy, you know, this is a pretty good gig sitting at home for a couple months, and I'm going to want to continue to do that. They do run the risk of forfeiting any unemployment that they otherwise would be eligible for.
And you would advise, you know, we've talked about documentation under the guise that the repayment portion guidelines are so sparse. You would advise a letter, you know, a drafted letter to that effect so that you can document each offer, if you will, to the employees.
Absolutely. Absolutely. Yeah, you have to document it. I mean, this is about as clear as it can be from Treasury or the SBA, but even in circumstances that don't fit in with the parameters of this exact question and answer, you're going to want to have documentation to the extent an auditor comes, you know, a year from now and says, okay, well, why did you had X number of employees and it looks like you just got rid of a bunch of people. Why did you do that? You better have a good explanation. You also have to think, if there were employees that weren't called back, how does that look in other discriminatory realms, right? You know, if you're calling back everybody but 10 women that worked for you, that's going to throw up red flags in other areas of law, whether it was intentional or not.
Right.
And so, you know, again, having the documentation of what you're doing, why you're doing, when you decided that is important.
Right. All right. Well, I think we're a little over the time. I want to give a few minutes to everybody out there. If you want to submit a question, we're going to officially hit the question and answer period. Give you a minute or two.
Yeah. And if we don't,
make sure we didn't miss any.
Yeah, if we don't get any additional questions from you guys, you can find out some more information by reaching out directly to Patrick. Just sent his information to the group chat on the Zoom. So his phone number is 412-580-1575, and his email address is pdennison@fisherphillips.com. You can also go to their website at www.fisherphillips.com to learn more information about CARES Act PPP. And also you can go to our website as well if you need some help with your real estate negotiations during this whole time, because obviously that 25% of the loan, it's only going to be a battle in the war. So, with your landlords, if we can reach out to them and renew you early, that's going to be preference. So again, Patrick, thank you again for your time.
Thank you very much.
You.
I
Great
appreciate
having
the
you
time.
here. And Sarah, thanks for joining us as well. And take care, everybody. Thank you.
Thank you.
Bye. Thanks, everyone.